Hi students, welcome back to my channel and let's start the next topic in revision series of advanced accounting, nothing but what amalgamation. And from this chapter you can expect at least one question for 14 marks. So we have the guarantee question in the final exam, and one of the important crucial topic here. And in this session, I'm not only discuss the concepts, and also I'm going to discuss at least 12 important questions from the exam point of view. So don't skip the video and follow the entire video. And if you like, please like it, press the like button, and also don't forget to subscribe it. And also please share it to your friends also. Okay. So and entire topic I divided into the two parts. In the first session, I will discuss purchase consideration. In the second session, I am going to discuss the accounting in the books of transferor as well as in the books of transferee company. Okay. Without wasting the time, I will move on to the topic. So, what is meant by amalgamation? So, generally, amalgamation stands for if two or more companies together formed as a single company, called as what amalgamation. So, for example, Vodafone and Idea combined together and formed as VI, and that is called as what amalgamation. And three similar words we have in practice, and those are simply nothing but amalgamation and absorption and external reconstruction. So, in case of amalgamation, here two companies, A Limited and B Limited, combined together and formed as a C Limited. So, two companies combined together and emerged as a new company, and this is called as what amalgamation. In this case, these two companies wind up, and the entire business of these two companies will be transferred to another newly established company, and this process is called as what amalgamation. And in case of absorption, here A Limited acquire the business of B Limited, or B Limited acquire the business of A Limited. Means what? A and B together will continue either in the name of A or in the name of B. Any one of the company has been wind up. So if A acquire the business from the B, then B will wind up and the two businesses will continue in the name of A. If the B acquire the business of A, then A will wind up and the two businesses will continue in the name of B only. In the name of B. Only one company wind up and another company will continue the businesses of the two entities. And here no new company has been formed. No new company has been formed. This is called as what? Absorption. And coming to the external reconstruction, for example, A Limited is suffering from the huge losses from the last few years, and that's why uh, in that case, and one of the process we have to do to convert the loss making into the profit making company to bring it. So so to bring that loss making entity into the profit making, and one of the activity we have to do called as reconstruction. As a part of reconstruction, two things we have: either internal reconstruction or external reconstruction. And in case of internal reconstruction, what will be the process? I will discuss it in later topics. Coming to the external reconstruction, here one new company is formed to acquire the existing company. To acquire the existing company, one new company is formed. This existing company will wind up. Will existing company will wind up, and the business will continue in the name of the new company, in the name of the new brand. And this is called as what? External reconstruction. In case of external reconstruction, so for closing the existing company, the entire business of existing company will be transferred to another new company which was formed by the same management. So here one company was closed and another company was opened. This is called as what? External reconstruction. And this is in case of amalgamation, two companies together formed as a new company. This is called as amalgamation. In case of absorption, one company acquired the business of another company. And in case of external reconstruction, a new company formed to acquire the business of existing company called as external reconstruction. And in this case, the companies which was wind up, the company whose businesses has been transferred to the another party called as transferor or vendor or selling, sorry, or selling companies. The company whose businesses has been transferred and the companies which was wind up or liquidated called as what, transferor or vendor or selling company. And the company to whom the business has been transferred called as what, transferee or vendee company or purchasing company or what, purchasing company. And in case of absorption also, the company which was wind up said to be a transferor and the company which will continue is said to be a transferor. And in case of external reconstruction, the new company formed is said to be a transferee and existing company closed is said to be a what? Transferor company. Transferor company. And here the AS14 amalgamation is applied only in the books of transferee, not in the books of transferor. AS14 is applied in the books of transferee, not in the books of transferor. Okay. And in this chapter, we have to discuss three topics mainly. One is the PC, and another one is accounting in the books of transferor, and accounting in the books of transferring. In this session, I will completely discuss the details about PC and problems relating to the PC. PC stands for what? Purchase consideration. And accounting in the books of transferor and transferee, will discuss it in later topic, later sessions. Okay. And coming to the PC, what is meant by purchase consideration? And purchase consideration here is nothing but aggregate of amount paid or agreed to pay by the transferee company to the shareholders of transferor company is called as what, PC. Is called as what, PC. PC here is nothing but the amount paid or agreed to pay by the transferee company to the shareholders of transferor company is said to be a what, amalgam. It is said to be a what, sorry, purchase consideration. And here the amount paid or agreed to pay is in which form? It may be paid in the form of cash or equity shares of transferee and preference shares of transferee and debentures of transfer. Debentures of transfer or even in terms of what, asset, either assets or also in any form. It may be payable in cash or asset or equity shares of transferee or preference shares of transferee or debentures of transferee and is payable to whom? To the shareholders of transferor. And who is the shareholders there? Either equity shareholders or to the preference shareholders. Only to equity shareholders or to preference shareholder. And remember, any amount paid to debenture holders or creditors or to the other liability holders or other liabilities, and remember, of transferor, this is not forming part of PC. This is what, not forming part of PC. Very, very important. Any amount you paid to the debenture holders of transferor company or creditors of transferor company or other liabilities of transferor company never be forming part of purchase consideration. Purchase consideration includes only that agreed amount payable by the transferee company in the form of cash or assets or equity shares or preferences or debentures of transferee company to the shareholders of transferor company, either to the equity shareholders or to the preference shareholders of transferor company. If any amount agreed to pay to the debenture holders of transferor company or to the creditors of transferor company or to the other liabilities of transferor company, never be forming part of purchase consideration. Never be forming part of a purchase consideration. And another important point is, sir, for example, transferor company is going to be liquidated. If transferee company pay the liquidation expenses of transferor company, if transferee company pay the liquidation expenses of transferor company, shall we consider it as a forming part of PC? No, it is not treated as a PC. So that liquidation expenses paid by transferee is also not forming part of purchase consideration. That is also not forming part of what purchase consideration. Okay. Okay. So purchase consideration covers only the amount payable to the equity shareholders of transferor. To the other person, never be forming part of this. But remember, you may pay the purchase consideration in terms of debentures of transferee. In terms of debentures of transferring, no problem, but not to the debenture holders of transfer. Okay, next. And how many methods we have to calculate purchase consideration? How many methods are there? And four methods we have. And one is the lump sum method, and net payments method, net assets method, intrinsic value method. In case of lump sum method, what it says, for example, A Limited acquire the B Limited, and A Limited agreed to pay 100 crore to the B Limited. And here the purchase consideration stated in terms of a specified amount, a lump sum amount. So that case is said to be a lump sum method. So how much amount you agree to pay to the shareholders of transferor company will be specified in terms of a specified amount or lump sum amount. That is covered under lump sum method. Second one, net payments method. In case of net payments method, so you have to consider, in this case, the PC is equal to what? Amount payable to the equity shareholder and amount payable to the preference shareholder. The aggregate of total amount agreed to pay to the equity shareholders of transferor company to the plus to the preference shareholders of transferor company is said to be a PC under net payments method. And to them, you may agree to pay either in terms of same, in terms of cash or equity shares or preferences or debentures of transferee company. You may pay in any form. What is the amount you agreed to pay to the equity shareholders of transferor? And what is the amount you agreed to pay to the preference shareholders of transferor? And that aggregate amount is treated as PC under which method? Net payments method. And third one, net assets method. And this is very important method, net assets method. If nothing was stated in the problem about the method, we follow this method only, net assets method. And under net assets method, purchase consideration is equal to total assets minus liabilities. This is what net assets of transferor, and this is treated as purchase consideration. Purchase consideration equal to what? Total assets minus liabilities. Total assets minus liabilities, and is considered as a purchaser consideration. Okay, and here here the total assets are considered at what price? Book value, or if fair values are given, we have to consider at fair value. If the fair values are not provided, then we consider them at the book value. We consider them at the book value. Okay. So if fair values or revalued figures are given, we consider that revalued figure. Or if fair values are not provided, we consider that what book value. And like property, plant and equipment, fair value, and plus and the land plus building or any intangible asset we have, plus current assets like stock and debtors, bank, etc. Total asset minus outside liability like debentures and creditors and other liabilities. This is the net assets of transferor company, and that is treated as PC under this method. Okay, and last one, intrinsic value method. In this case, intrinsic value intrinsic value is nothing but net assets by number of equity shares outstanding. Net assets by number of equity shares outstanding. And you need to calculate intrinsic value of each company, nothing but for transferor company as well as for transferee company. Then we computed PC by using the swapping method. The PC is equal to what? Number of equity shares of transferor into intrinsic value of transferor by intrinsic value of transferee company. Number of equity shares of transferor into intrinsic value of transferor by intrinsic value of transferee. And this is the way of calculating what PC. So normally in majority cases we have the problems from the net payments method and net assets method, and sometimes you may have the problems in combination of net payments and net assets method. Okay, so these are the four methods we have relating to the calculation of purchase consideration. Nothing but lump sum method, net payments method, net assets method, intrinsic value method. I hope you guys understood about the concept of purchase consideration. And remember, amount agreed to pay to the shareholders of transferor company is only forming part of purchase consideration. Others, if any amount payable to the debenture holders, creditors, other liabilities of the transferor, or any amount of liquidation or realization expenses be paid and never be forming part of purchase consideration. Okay, then so this is about basic. Then we'll move on to the problems. And first problem number one. A Limited take over B Limited on 1st April and discharge the consideration for the business as follows. Issued 42,000 fully paid up equity shares of 10 each at par to the equity shareholders of B Limited. Amount payable to equity shareholder is included. Issued fully paid up 15% preference shares of 100 each to discharge preference shareholders of 1,70,000 rupees of B Limited at premium of 10% to the preference shareholder. This is also included in definition of PC. But it is agreed that debentures of B Limited 50,000 will be converted into equal number and amount of 13% debentures of A Limited, and this is not forming part of PC. Only amount payable to equity shareholder is covered. So to the equity shareholders, how much? So 42,000 into 10, 4 lakh 20, and to the preference shareholders, how much? How many shares? 1,70,000 worth of the preference shares are discharged at 10% premium. Nothing but what? 1,87,000. This is the amount agreed to pay. But each one issued at 100. Nothing but number of shares are 1870 into 100. So purchase consideration is equal to what? So 6,07,000. This is the piece of money. So amount payable to the debenture holders of transferor company is not forming part of purchase consideration. Okay, this is the first one. And second one, similar problem. And in this case, on 1st April 2018, Tina Limited take over the business of Reena Limited and discharge the PC as follows. Issued 50,000 fully paid up equity shares of 10 each at premium of 5 rupee per share. So, to the equity shareholders paying in terms of what equity shares. How many equity shares we are issuing? 50,000 into 10 rupee share issued at 5 rupee premium, nothing but 15. 7 lakh 50 in terms of cash 50,000, and these two elements we pay to the equity shareholder and is forming part of PC, and issued 2,000 fully paid up 12% preference shares of 100 each at par to discharge the preference shareholders of Reena Limited. So to the preference shareholder, how many shares? 2,000, each one is issued at 100 rupee at par, so nothing but what, 2 lakh. And debentures of Reena Limited 20,000 rupees will have converted into equal number and amount of 10% debentures of Tina. And remember, this is never be forming part of purchase consideration. And total 10 lakhs. The purchase consideration is nothing but what? 10 lakhs. Okay. Next. Third one. Moon Limited is absorbed by Sun Limited. And it means what? Sun Limited is the transferee and Moon Limited is the transferor, right? And being takeover of liabilities and the payment of cost of absorption not exceeding 10,000 and actual cost. And remember, cost of absorption not included. Where? In PC. And payment of 9% debentures, 50,000 at premium or 20% through 8% debenture. And so debenture amount paid to the debenture holders. So not forming part of PC. And next, the payment of 18 rupee per share. So here PC covers from this point. The payment of 18 rupee per share in cash and allotment of two 11% preference shares of 10 each and one equity shares of 10 each at premium of 30% fully paid up for every 3 shares in more limited, so respectively the number of shares of vendor companies 1,50,000 each. And here to the equity shareholders, we are paying in cash. How many shares? So for every 3 shares, nothing but, so for every 3 shares means 1,50,000 into 1 by 3, 50,000 shares. So 50,000 into each one is payable at 18 rupee per share, 18 rupee. So is a nothing but what, 9 lakhs. Just calculate it. 50,000 into 18, 9 lakhs. And in terms of equity share. So allot to 11% preferential and in quoting another one. So in terms of preferentials. So 50,000 into 2. Two preferentials have been issued at 10 each. At 10 each. So nothing but what? 10 lakhs. And here one equity shares of 10 each at 30% premium. 30% means what? 3 rupee per share premium. So 50,000 into 13, 6 lakh 50,000, correct? So 50,000 into 13, 6 lakh 50, and 50,000 into 2 into 10, 10 lakhs. So here, so PC is here is nothing but what? 25 lakh 50,000 is the purchase consideration. Amount paid towards cost of absorption, amount paid to the debenture holders of transferor company not forming part of PC. Okay, next. And fourth one, and balance sheet of A Limited was given, and notes to accounts. And here the PC data, and discharge 15% debentures at a premium of 10% by issue of 15% debentures of Excel Limited. So here, long-term borrowing. So 15% debentures are how much? 7 lakhs into 10% premium. And that means 10%. Nothing but 7 lakh 70,000 we agreed to pay to them. PPE at 10% above the book value. What is the PPE here? 32 lakh 50,000 at 10%. At 10%. So 32 lakh 50 plus 3 lakh 25,000. 35 lakh 75,000 for PPU. And investment at par, nothing but what? 6 lakhs only. And current assets at discount. What is the current assets part? Total current assets we have here is nothing but 5 lakhs minus 10% discount. Nothing but 4 lakh 50,000 we agreed to pay. And current liabilities at book value only. Current liabilities at book value, nothing but 5 lakhs. We consider. And so preference shareholders are discharged at premium of 10% by issuing 15% preference shares of 100 each. Preference shares are discharged at 10% premium. Okay. So how many preference shares we have? So total 7 lakh 50,000 worth of preference shares are there plus 10% 75,000 premium we provided. And next, issue 3 equity shares of 10 each for every 2 equity shares in B Limited and pay this amount. This point is important. Balance in cash. Pay what? Balance in cash. But how much amount? What is the balance amount? Balance amount we don't know. And here the last 2 points D and E are relating to the net payments method, and the first 3 points are relating to the net assets method. If the net payments method complete data was given, we follow that one. There is no problem. Clearly mentioned, follow the net payments method. But in net payments method, one balancing figure was given. So we need to calculate PC out of that to the preference shareholder, how much amount we pay, to the equity shareholders in terms of equity share, how much amount we pay. If you deduct, then the remaining is the balance payable in cash. So the PC is required to be calculated by using which method? Net assets method first. So net assets method means total assets minus outside liability. What are the assets we have? First, PPE. PPE is at 10% above the book value. Nothing but 35 lakh 75,000. And second one, investment. Investment is made at par. Sorry, made at book value only. Book value. And next, current assets. Current assets are at discount. So what is the current assets we have? 5 lakh minus 10%. 4 lakh 50,000 current assets. And this is the total assets. And minus, we have to reduce what? Debentures. And debentures we agreed to pay 10% premium. Nothing but 7 lakh 70,000. Current liabilities we considered at uh, book value only. What is the book value of current liability? 5 lakhs. So purchase consideration equal to. So 35 lakh 75,000 plus 6 lakhs plus 4 lakh 50,000 minus 7 lakh 70,000 minus 5 lakhs. Nothing but 33 lakhs 55,000 is the PC. But out of that, to the preference shareholder, how much amount they agreed to pay? At 10% premium. At 10% premium. What is the preference share capital? 7 lakh 50. 7 lakh 50 plus 10%. Nothing but 75,000. 8 lakh 25,000. And to the equity shareholders in terms of equity shares. In terms of equity share. 3 equity shares of 10 each for every 2 equity shares. 3 for 2. And B Limited, how many equity shares we have? 1,50,000 into 3 by 2. Okay. So 1,50,000 into 3 by 2. How many shares we agreed to issue? So 2,25,000 shares. And each share was issued at par. So nothing but 2,25,000 into 10. 22,50,000. 22,50,000. Then what is the in cash? Nothing but balancing figure. So 33 lakh 55,000 minus 8 lakh 25,000 to the preference shareholder, 22 lakh 50,000 in terms of equity share, and the remaining amount is 2 lakh 80,000 payable in what? Cash. And this problem is the combination of net assets and net payments method. You need to calculate what is the PC as per net assets method, and then as per net payments method, we have to segregate it, and the balance amount is the missing figure. Here, the missing figure is what is the amount of cash payable to the equity shareholder. Okay, I hope you understood. And as if assets are given at a revalued figure, consider revalued figures while calculating net assets. If nothing was stated, consider it book value. Okay, next. Coming to the next one. So balance sheet of Excel Limited was given, and it's a data notes to accounts. And here is the PC details. Y Limited take over Excel Limited, and it means Y Limited is the transferee company. Excel Limited is the transferor company. Debenture holders of Excel Limited are discharged by Y Limited at 10% premium by issue of 15% owned debentures. And remember, this is not forming part of PC because amount payable to debenture holder never be forming part of PC. 14% preference shareholders of Excel Limited are discharged at premium of 20% by issue of necessary number of 15% preference shares of Y Limited. And it means, so to the preference shareholder, how many shares they issued? So for at a premium of 20%, at premium of 20%, what is the preference share capital? 25 lakh. So what is the amount payable? So 25 lakhs plus 20%. Nothing but what? 30 lakhs. Nothing but what? 30 lakhs. But how many shares? Each share was issued at par. Means 30,000 shares are issued. 30,000, 15% preference shares are issued. And next to the equity shareholder. So here intrinsic value. This is important here. Intrinsic value per share of Excel Limited is 20 rupee and that of Y Limited is 30 rupee. And Y Limited will issue equity shares to satisfy the equity shares of Excel Limited on the basis of intrinsic value. But however, this point is important. However, the entry should be made at par only. The entry should be made at par value. And nominal value of equity shares of Y Limited is 10. So first of all, how many equity shares are there in Excel Limited? 7,50,000. And it means first of all, how many shares issued? So 7,50,000 into number of equity shares of transferor into intrinsic value of transferor company, nothing but 20 by intrinsic value of transferee company. So 7,50,000 into 20 by 30. Nothing but how many shares we issued? 5 lakhs. And each share, the entry should be made at what price? Par value. What is the par value? 10 rupee. 5 lakh into 10, 50 lakhs. Then what is the PC? 80 lakhs. What is the PC? 80 lakh. For example, if the entry recorded at par is not given, then what is the PC? Coming to preference shareholder, same thing, 30 lakhs. But coming to the equity shareholder, we have to write what? 5 lakhs into what is the intrinsic value of a transferee company Y Limited? Nothing but what? 30. Intrinsic value of Y Limited 30. Nothing but 150 lakhs. This is the PC. If entry is not recorded at par value, entry recorded at par value is not given. Because of this point, and the PC is restricted to 50 lakh only to the equity shareholder. But here, if the entry should be made at par value is not given in the problem, we have to consider them at intrinsic value only. Then 5 lakh into what is the intrinsic value of transferee company? 30. 1 crore 50 lakh. In total PC is 1 crore 80. Okay. And another one. So Neil Limited and Gagan Limited amalgamated to form a new company. And the two companies, Neil and Gagan are Transferor, and new company is the Transferee. And here the balance sheets are provided relating to two companies. And coming to the PPE, data is provided, Neil and Gagan. And following is the additional information we have. And the assets of Neil Limited and Gagan Limited are here. Revalued figures. Revalued figures are provided relating to this one. So this is the book value and this is the revalued figure. Purchase consideration is to be discharged as under. These are the PC conditions and one of the important problem relating to the PC. And issue 24,000 equity shares of 25 each fully paid up in proportionate of their profitability in preceding 2 years. In preceding 2 years. So full in their proportionate of the profitability of last 2 years profit. What are the profits of last 2 years? Neil Limited 4 lakh 75, Gagan Limited 5 lakh 25. So the 24,000 is divided in between Neil and Gagan in what ratio? 475 is 525. 475 is 525. So 24,000 into, so 24,000 into, so what is that? So 475 by 1000. So in proportionate of their profitability in preceding 2 years. So how many shares? 11,400. 11,400 in the remaining 12,600 into 25. So 3,15,000 here and 11,400 into 25, 2,85,000. This is the PC to the equity shareholder. And another one, issue 12% preference shares of 10 each fully paid up at par to provide income equivalent to 8% return on net assets in the business as on 31st March after revaluation of assets. After revaluation, what is the net assets we have to calculate? And here, what is the net assets? So total assets here is provided, but we need to consider what? 1 minute. So we have to consider what? Revalued figures. So what is the revalued figure of plant and machinery? So Neil and Gagan. Revalued figure is 5,25,000 and 6,75,000 and building 7,75,000, 6,48,000 and coming to the current assets 1,63,500, 1,58,600. Because if no revalued figures are provided, we consider them at book value only. And minus current liabilities. So 6,23,500 and 5,57,600. And this is what net assets. Then we'll see computed. So 5,25,000 plus 7,75,000 plus 1,63,500 minus 623,500, 8,40,000 and 6,75,000 plus 6,48,000 plus 1,58,600 minus 5,57,600, 9,24. This is the net assets. And what it says, on the net assets, we have to earn the income of 8% return, 8% on net assets. So into 0.08, 73,920. So 8,40,000 into 0.08, 67,200. So 8% return. So issue 12% preference shares of 10 each, fully paid up at par to provide income equivalent to what? 8%. And in future, if you issue the preference shares, they will get 12% preference dividend, but the dividend should be equal to this amount, 67,200 to the Neil Limited and 73,920 to Gagan Limited. Then how many preference shares we issue? Then 12% preference share capital, nothing but what? 67,200 by 12, because this amount equal to 12%, and 73,920 by 12%. How much? By 0.12. 5 lakh 60,000 and 73,920 by 0.12. Nothing but 6 lakh 16,000. 6 lakh 16,000. So you are required to compute equity and preferentials issued to Neil and Gagan Limited. What is the PC? And here PC is nothing but, in case of Neil, in case of Gagan, equity shares 2 lakh 85,000, 3 lakh 15,000, and the preference shares 5 lakh 60,000 and 6 lakh 16,000. And this is what PC. This is what PC. So this is very, very important. And here they clearly mentioned issue the 24,000 equity shares of 25 each, fully paid up in the proportionate of their profitability in preceding 2 years. But sometimes in the problem you may have in the proportionate of average of last 2 years profit. In that case, 4 lakh 75 by 2, 5 lakh 25 by 2. In that proportionate of average profit, we have to distribute 24,000 equity share among the Neil and Gagan, but only in the proportionate of the profitability. That's why we segregated in this way. And coming to the second one, issue 12% preferentials of 10 each, fully paid up at par to provide income equivalent to 8% return on net assets. First, we have to calculate net assets of Neil and Gagan Limited by considering revalued figures, and we calculated it on that 8% portion, that is the return. That 8% is equal to 12%. What about the 100%? 67,200 by 12%, 73,920 by 12%. Then we get amount of preferentials we agreed to pay by 100 rupee. What is the sorry, by 10 rupee? Then we'll get number of preferentials we agreed to issue. Okay, this is about what? PC. Okay, so these are the problems relating to what? Purchase consideration. Okay, I hope you guys understood, and this is the core part of amalgamation. For doing the problems in the books of transfer or in the books of transferee, first we have to compute what is the purchase consideration. So max, I covered all topics relating to the purchase consideration. Max, all problems we covered here. I hope you enjoyed, and in the next session I am going to discuss accounting in the books of transferor company as well as in the books of transferee company. Okay, and I hope you enjoy the video. Okay, so without skipping, please watch the entire video, and if you like, don't please press the like button, and don't forget to subscribe my channel. Okay, thank you. Bye bye.